Hey guys, it's Brandon here, and we're on site today at the Atlantic Holiday again. I'm gonna take a deeper dive into the market analysis that I've been doing on this property. This property is a gold mine. I know it's not wrapped in, gold wrapping and screaming, "Hi, I'm an excellent opportunity." It does not change the fundamental financials on this property. This property is currently producing $44,000 a year in profit. And the trade area demand in the low end of the segment, as you're about to discover, it's there. There's over 500. This market is undersupplied by as much as 539 units. Yes, I'm gonna dive into that. I'm gonna show you what the low end demand is. I'm gonna show you what the low end supply is, and you're gonna find that there is a gap and a currently underserved market right here in this trade area. Additionally, I'm gonna dive into the high end of the market. We're gonna walk through that and how it's oversupplied so that we can really break down the market analysis of this trade area, understanding the fundamental differences in the products that are on the market so that you can actually see, hey, even in an oversupplied market, where is that oversupply coming from? Well, in this instance, it's coming from properties that are over $1,450 asking rent a month. Now, I don't want to labor it. I do want to point out, guys, that I am just blocks from the beach. You can see the ocean right there. Yes, this property is a gold mine. And in fact, you know what? I'm just going to go into it with you. The idea here is to find properties east of Business 17, which is walking distance to the beach, that can be converted into multifamily properties to serve the low end segment. We're talking about hotels, motels. That's the play. That is the play in our market. That's the strategy that a savvy real estate investor in commercial properties would follow in this market based on the market analysis of this trade area. It's that simple and that easy. So, just to recap, you're going to discover in this video that there is plenty of low-end demand. You're going to find out that it's not being served, and that the best strategy to utilize is to find these, well, I would say there's two strategies, is to find properties that you can convert into low-end segment serving multifamily properties, number one, and then number two, the next best strategy, I can't wait to tell you this, all the high-end properties that have been built up in this area, creating the oversupply, they're having issues meeting their financial demands. They've got financing on these properties and it might be working now, but these commercial loans only last for 5 years. So what happens when interest rates stay up and it comes time for them to refinance that property because their loan term's up? What are they gonna do? If the new interest rate is higher and the numbers no longer work, they're gonna hurry up real fast and put that multifamily property that was recently built in this market on the market to sell it. Now, what are you gonna do? You're gonna repurpose that high-end multifamily property to serve the low-end market if it's possible and if it's feasible. Or you're gonna convert it down to just the medium segment of the market. So there are two strategies east of Business 17 that you can utilize right now as a savvy real estate investor to really take advantage of the market dynamics. Now, I don't want to hold us up. I know I'm just dropping it on you straight out of the gate this time. We need to get into the video. Let's get into the video now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years, whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. Now, very quickly, we're going to cover some ground that we covered in the previous market analysis video on this property. I want to lay a solid foundation and kind of build on the previous work that we did, but I'm going to extrapolate something completely different. We're going to take that analysis even deeper and dive into both the low-end segment and the high-end segment market demand in the trade area. I want to show you that it's oversupplied in the high end of the market and undersupplied in the low end of the market, which is what the subject property type serves, to show you the value and the demand, and to show you that basically this is going to be a stabilized investment. You're not going to have to worry about where you put your money. So I just want to give you a quick heads up. We're going to dive into a little bit of the material we did in the last video to lay that solid foundation for what's upcoming. All right, now what I want to show you about the Atlantic Holiday is how to calculate either the surplus or the gap when it comes to multifamily property demand in a given trade area. So the first calculation that we're going to do is going to be the current rental demand. Now, ultimately, we're going to find out what the total population is, which you can see from our infographic is 20,242. We're going to subtract out group quarters. Now, group quarters are non-household population, military-based people, or on-campus student housing. Those are people that would not be included in a household. By the way, you don't calculate multifamily demand based on population alone. You calculate it based off of households. Now, we'll take the total population at 20,424. We're going to subtract out the group quarters because those people aren't in households that would be part of the demand to rent a multifamily property. Obviously, they're on a military base. They're on a student campus. They are, wherever they are. Anyways, so we take the total population, we subtract out the group quarters, and we're left with household population. That's 20,223. Now, we need to know what the number of people per household is in the trade area. On our infographic, the average household size is 2.2. So then we're going to take that number, the household population of 20,223, we're going to divide it by the average household size of 2.2, and we're going to find out that there are occupied households in the trade area to the tune of 9,192. Now, that's an important number. Next, we're going to find out what the renter-owner ratio or the tenure is, or tenure, excuse me. And basically, we'll take the renter-occupied housing units, which were 4,723, which you can see on the infographic that I pulled in the site to do business for the trade area. And then we're going to divide it by the total housing units in that trade area. And that's going to give us a renter-owner ratio or a tenure of 40.7 or 0.407. Now, we're simply going to take that ratio tenure and we're going to multiply it by the current number of occupied households in that trade area. And that's going to let us know what the occupied rental households are out of the occupied households in the trade area. So all that being said, when we multiply 9,192 by 0.407, we're left with occupied rental households to the tune of 3,738 in that trade area. Now, we obviously have to gross that number up for vacancy. So we figure out what the vacancy is in the general area, in the trade area. For our information here, I just used the vacancy rate for the subject property, which was 92.5%. So we have to gross that number up to account for vacancy because there has to be some level of vacancy in the trade area, because if not, people, there would be no room for growth. People would just be moving out of the trade area, out of the trade area altogether, and they wouldn't be moving into the trade area if there wasn't room for vacancy, if that makes any sense. So obviously, if nothing's vacant in the trade area, they have no choice. They can't move into the trade area. They can only move out of the trade area. Well, we know that that's not the case. There is a market average vacancy and there's a trade area vacancy. Again, I just applied the subject property vacancy rate. It was occupied to the tune of 92.5%. We grossed that number up, and now we've taken the occupied rental households and we've increased them to 4,041, taking into account vacancy, because we know realistically people are moving into the trade area. Okay, now, that's our first calculation. We've officially arrived at the total rental demand in households in the trade area. Next, we're going to calculate the rental vacancy calculation. Now, we're going to take the total vacant housing units. Again, it's right here in our infographic that I ran for the area of 2,567. We're going to multiply that by the renter-owner ratio, or your tenure. Again, that's 0.407, and that's going to give us the total vacant renter units that are out of the total vacant housing units altogether. So there's a current amount of vacancy in the trade area to the tune of 1,044. Now let's just kind of backtrack and make sure we're all staying on the same page. The total rental demand in households is 4,041. The total renter units that are vacant in the trade area are 1,044. Now let's keep going. Next, we're going to calculate our rental supply calculation. Now, this is going to be the renter-occupied housing units, which was 4,723, which we found from our infographic in the site to do business. We're going to subtract out the vacant units from that, which was 1,044. We just figured that number out. Excuse me, we're going to add in those numbers. We're going to add in the total vacant units, and that's going to give us a total renter housing units of 5,767. So we know that there's a supply in the trade area to the tune of 5,767 renter units. It's that simple. Now, if we take the total households that are in demand in the trade area, our very first calculation, which was 4,041, and we subtract out our total rental units of supply that we have in the trade area, which was 5,767, we are left with an oversupply and not a gap of 1,726 units. In other words, if you're just using this one metric to calculate whether or not there's demand in the trade area for this product type, then it would indicate that there's not. But we're going to get a little bit more granular and look at the different types of competition, the different types of multifamily competition properties in that trade area. And we're going to look at what they're charging in rent. And we're going to differentiate the market from the top end to the low end. And we're going to take out, hey, how much supply is there that it's actually targeting this kind of renter? How much supply is there in the trade area that's actually targeting the low end of the market, rents rents around $1,200 versus, rents that are $1,750 and above. So we're going to look in that trade area and we're going to go based on the supply that's in the trade area and based on the rents that are being charged in that trade area, how many multifamily properties are actually servicing people that are in that $1,200 and below price range, affordable rental housing, versus how many of those supply properties, because it says it's oversupplied, are actually servicing $1,750 and above rents. And if we can see that there is only a handful of properties servicing the affordable income area in that market, and there's a ton of demand for the affordable income area in that market, then we can predict, okay, this multifamily property is going to have stable rental income in the next 5 years, in the next 7 years, because everything that's being built or has been built in that trade area is servicing a different person altogether that's paying $1,700 a month for rent. So while there may be an oversupply in that $1,750 rental market, there may in fact be an undersupply in the affordable rental market. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry, because of the 20 to 22 million tourists that visit our market each year, which is the number 2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors including families, snowbirds, and golfers. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories. Now on your screen, you're gonna see the low-end trade area demand for studio and 1-bedroom units. Essentially, the first section is type. That's male householders living alone. The percentage of households in this trade area is 18.7%. Male householders living alone are 18.7% of the households in this trade area. Now the total rental household demand was 4,041. Well, out of that 4,041, that means that the segment demand for studio 1-bedrooms for male householders living alone is 756 units. Additionally, the same logic applies for female householders living alone. 18.9% of the households in this trade area times that 4,041 total rental household demands in the trade area leaves you with 764 segment demand studios for 1-bedrooms and studios for females. That's a total low-end rental trade area demand of 1,519 units. Now, you're probably curious, well, Brandon, where did you get this information? This information came from the Site to Do Business through the Certified Commercial Investment Member Analysis program, basically. You know, it's a Site to Do Business program where we pull the numbers. Now, these numbers are based on the 2020 households by type in the trade area. I simply ran a report for this trade area, and in this trade area, I pulled these numbers. It's that simple and that easy, guys. Now, moving right along, let's plug that into the low-end rental supply in the trade area under $1,450. So I went into CoStar, I ran a list. I want to know all the multifamily properties that have an asking rent under $1,450. I ran those numbers. You can see that on your screen. There was a total of 980 units. Well, if we have demand for 1,519 units and we have supply for 980 units, well, if you take demand and you subtract out the supply, you're left with a currently not being served, underserved demand of 539 units right now in this trade area. That's why this property, the Atlantic Holiday, has a 92.5% occupancy rate, because they are serving an underserved market in this trade area. It's that simple and that easy, guys. Now let's move right along to the high-end trade area demand for studio and one bedrooms. We've already found out that in the low end, there is not enough supply to meet the current demand. Well, what's going on in the high end part of this trade area? Well, very simply, married couple households without own children represents 20.5% of the households in this trade area. Multiplied by the total rental household demand leaves you with a segment demand for studio and one bedrooms of 828. Now, you have cohabitating couple households without children under 18, represents 5.4% of the households in this trade area, times the total rental household demand, which is 4,041, gives us a total segment demand of 218. That gives us a total high-end rental trade area demand of 1,047. Now, I'm gonna go on CoStar and I'm going to run all of the properties that have an asking rent that are multifamily in the trade area above $1,450 asking rent. Well, I ran that number, and sure enough, guys, that high-end rental supply in the trade area was 1,629 units. So currently, there are 1,629 units that have one bedrooms and studios that have an asking rent higher than $1,450. Well, if we plug in our demand number, our figure, which was 1,047 units for demand that have an asking rent above $1,450, and then we plug in our supply, which is 1,629, we are left with an oversupply of 582 units in the high-end segment of this trade area. So what this shows us, guys, is very simply, the underserved or low-end part of this trade area has a ton of demand to the tune of 539 units. The high end is oversupplied, which is what I was telling you from the beginning. There is plenty of rental units on the market over here that they're charging rents that people can't afford. There's not enough one bedrooms and two bedrooms offering those low end rents. It's that simple and that easy. This property doesn't have to worry about having stabilized income. It doesn't have to worry about it because the whole trade area is underserved by 539 units. That's a guaranteed income, basically. Now, obviously, there's no guarantees. At the same token, you don't really have to worry about renters running out. If they run out, another renter will jump right back in this property because the whole trade area is underserved by one bedrooms and studios. So if you want almost guaranteed rental income over the life of your investment, it's sitting right there. It doesn't have all the bells and whistles. It's not the prettiest multifamily property I've ever seen. Does it need some TLC and some work? Yes. Is your rent going to be stabilized and economically resilient? In my opinion, all day long. The whole trade area is underserved. I can't say it enough. It shows the value of this property. You can put your money in this property and you're going to get a return on it. You don't have to worry about it not being rented in this trade area. There's not enough supply to meet the demand in the low end of the market. Now, we're going to unpack this just a little bit further. Let's get into that. All right, so let's talk about the actual market opportunity. Units not served in the trade area were 539. Asking rent per month is $1,450. Your monthly rental income is $781,918. Times 12 months, your annual rental income, $9,383,018 is currently sitting on the table right here in this trade area. Now, that should open your eyes to the fact that this low-end segment serving property is a phenomenal and in-demand property right here in our market. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because this is the fastest growing area out of the 150 most populated areas in the entire United States for the last 3 years in a row, according to U.S. News and World Report. This helps to insulate our market from many of the ups and downs that the rest of our nation's real estate market experiences. This can help you have a more stable rental property. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because they have a tremendous upside when compared to money market accounts and the stock market, due to the appreciation they earn and the potential of higher annual yields through their gross rental income when compared to these other investments. Money market accounts and the stock market don't have the upside of added appreciation. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because while our prices have risen and have held their value, we're also much cheaper than other places like Florida. If you're getting into the real estate game or expanding your current portfolio, the bang for your buck is sitting right on the Myrtle Beach, South Carolina oceanfront. In summary, in the multifamily market, in this trade area, essentially, there are too many expensive units chasing too few high-paying tenants, while affordable housing is underbuilt and undersupplied. This dynamic shifts pricing power and occupancy strength to well-positioned, affordable assets, like the one we've been evaluating right here at the Atlantic Holiday. That's what's going on here, guys. Plain and simple, it's that easy. That's the takeaway. That's the big win. You've got a ton of opportunity, of market opportunity right here, east of Business 17 in this trade area for multifamily properties in the low end segment. Everybody else is serving the higher rents. It's that simple and that easy. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories.